Hello and welcome to Pitch the PM. My name is Doug Garber, and I'm here with one of my former colleagues, Jonathan Kasen. Jonathan was a portfolio manager at Fidelity, and I've known him for probably 10, 15 years, and now he's moved on to be an entrepreneur and is following in Warren Buffett's footsteps and has become a chocolatier. He owns and is running two chocolate companies in the Northeast, Hilliards Chocolate, and he can tell you all about that. I'm very excited to have him on.
Thanks for having me on, Doug.
I was hoping we could start by you just giving us kind of your journey to get into Fidelity, what it was like. How'd you land a seat there? I mean, that's an amazing accomplishment in and of itself. And then you had a long career there. And if you could tell us that part of your journey.
I was always interested in the stock market, like as a kid. It kind of started with baseball cards. I just kind of always had this interest in markets and predicting the future. And like, I like getting rookie cards for players I believed in and then see if I can sell them later on. So it's, my parents saw that early on. And I'm dyslexic. I was a bad student. My parents said, well, he's got an interest here. So maybe we could inspire him to find a career that'll work for him. My mom had this giant value line book that she had from her like stock group that she had with her friends. And so I used to just page through there. I'd pick out like 5 or 6 stocks that I don't know why I would pick it based on whatever number, whatever chart looked interesting to me. Started to remember what was, maybe it was just a product that I liked. But then I would go into the newspaper every morning and see how they were doing and pretend like I invested. This is before you could do this all online, where do a paper portfolio online as well, which I did as soon as college came around. I bought my first stock at 14. It was Ashworth Golf Apparel. I like the brand. And so I was like, oh, to me, it was a growth industry because I just learned it. I didn't really have any other sense beyond that. And then somebody told me about another stock that I should sell that and buy. And so I was, I guess that sounds good. And I did that and the stock went to zero, which is my first lesson to do your own research and stick to your own thesis. So I went to Boston College. I was a finance major. I didn't really understand what careers existed in finance. I looked at my sister was an actress in New York City. I was like, I want to get to Wall Street in some form. She was working as a receptionist at Montgomery Securities that was eventually bought by B of A, or Nations Bank and then bought by B of A. And so she talked to somebody and said, hey, my little brother wants to get into this. And so they brought me in and I was working at a trading desk, basically getting sandwiches for people and just and helping with the kind of the back office type stuff. But it was, I get to put on a suit and go to Wall Street every day for I did that actually for 2 summers. But it was a good experience doing that. And then for my junior year, I did my internship at Credit Suisse. I got an internship on institutional sales desk. I thought that might be a good avenue for me. But as I got in there, I was like, okay, I'm starting to get an understanding of these different roles and different companies that exist. I don't want to be a trader because I always thought I was investing in companies. That's not exactly what they're doing. Institutional sales you're very much in the investment world and you're learning these names, but it is more of a sales job than a research and investing role, which is what I was ultimately interested. And then I also got some exposure to the sell side while there. And I was like, I'm getting closer and closer, but this isn't exactly what I want. So by the time I did all those internships, I was like, all right, I want to do buy side equity research. And so that's what I focused on coming out of BC. I got a job at Hellman Jordan Management, which was a hedge fund, but sort of private office here in Boston. And that was a great experience. I was there for 3 years, really experienced investors. They'd like to do a lot more technical than fundamental, but my role was exclusively fundamental. But I was a mile wide, inch deep. And so I really didn't feel like I was necessarily getting a good understanding of like kind of deep, like accounting strategy of these companies. So I went to business school, applied to a bunch of places, was accepted at USC and then was waitlisted at all the other top schools. And I decided to quit my job to go travel. And I was like, what are these, actually I was like interviewed stage at Harvard and at Chicago and waitlisted at Columbia. I was like, all right, I'll get into one of these places. Anyways, I went to USC. I didn't get in any of those. And that ended up being a blessing because they had a great investment program. And a great group of people to sort of work with. And I did my first internship at Fred Alger in New York, which is a growth shop. That was a great experience. I was interested in working there full time afterwards. but they hired so many people right at the end of the year. I don't know if you know the story of Fred Alger, but they lost a lot of people on September 11th. And so I had come in like, this is like 2004 when they were still kind of, recovering from that. And I think that was the moment where they were really growing and they hired a bunch of people. So they said, we'll get back to you. We'll see what our needs are in a few months. But in between then and at that point, I actually got the full-time offer to go to Fidelity, which was my first choice. And I was super happy about that.
And they were recruited from the top MBA programs like USC.
It was at a time where they were, I think, more open-minded because they were expanding out pyramids. And so they were looking maybe for 2 or 3 more analysts they normally would. So we had cast a little wider web.
Good name there. Well, there's some great experiences, to have. A big thank you to Street Account by FactSet for helping in the research process for these episodes. I've been a big fan of this product since it came out many years ago. It's a staple in my process and serves as the top of funnel for all names on my watch list. I just enter the ticker and I'm instantly in the flow for all key news flow, allowing me to ramp on the name while I manage the rest of the book. And I also use it to monitor customers and competitors for names that I already have in the book. It ensures that I do not miss anything. And they also have value-added analysis in their earnings summaries with historical valuation ranges, and they also report consensus earnings revisions right after the company's report, which saves me a lot of time on gauging what level to add to a position or not and see if the stock move was justified. If you don't use it, I suggest it. So you get to Fidelity, and congrats on that. That was been most people's like dream job to get in there. Kind of the blue chip quality name. And talk to me about your career there. I mean, you were there for a long time, over a decade, I believe.
Yeah, I think it was about 13, 14 years. Yeah. It was definitely the dream job. I was super excited, went out there. We had a big MBA class that year. And, they were interesting in that their whole thing was rotating people around and challenging people in new sectors and getting fresh look on stocks. My first trip was to Beloit, Wisconsin to look at a motor company because I got industrials. So I got small mid-cap industrials and kind of multi-industrials. That was sort of my pumps and valves and industrial distributors and all that. It was a great experience. I got promoted there to running our industrial equipment fund within a few years. And I was covering the large cap multis, like 3M and ITW and ITT. That experience was a big part of how I identified chocolate in Hilliards as a good investment going forward. Kind of the factors that, because these are all very mature businesses. So it's like, how do you create value with a low organic growth rate business? And if you look at industrials, you'll see that some can compound 25% a year and other ones can be flat for 20 years. So it's an interesting space to really learn about how to create value.
So what are those characteristics that you looked for in, call it, quality industrial companies that you said, hey, this is when I go out and start my own entrepreneurial journey, these are the characteristics that I want to see in a company that I own 100% of, that I'm putting all my time and energy into?
So I was looking at multis. I did this analysis this is back in 2007. This is all back, far back. And I remember I was just like, all right, so here's a group of multi-industrials over the last 10 years. We know what their performance was. And so like, what sort of characteristics about these companies? What factors really were the drivers of what the ones that went up, 15, 20% a year, and the ones that were basically went up 5% a year? There was really 4 things that really mattered. First is organic growth rate. So if the difference between growing 5% versus growing 2% over a 10-year period is a lot in terms of, what your profitability growth, earnings growth is going to be over that time. Especially if, number 2, operating leverage or incremental margin relative to operating margin, to your current average margin. So if your incremental margin is 45% and you have a 15% operating margin, that each 1% growth will lead 3% EPS growth, right? That ratio of 3 to 1.
Now, can you just back up and explain what incremental margin is for people who might not have seen that?
Basically means like for every dollar that you grow from here, how much does that contribute to your operating margin profit? And really, if you just look at sort of the change in profitability over a period, over the change in sales, you can look at that number. That'll give you a sense of sort of operating leverage for the business. It gives you a little bit of an idea of what the variable versus non-variable expenses are. And also, pricing and how that also plays in as well. Yeah, so operating leverage mattered. So if you had one company that grew 5% with 45% incremental margins, that company would grow 15% just organically, profitably, right? The 5% times 3 times their margin. But if you had a company that was growing 3% and it was only their incremental margins were 30 versus 40, then they're growing 6% a year. And in industrials, you have to do a lot of things just to get an extra 1%. You have to get exposure to a growth market. You have to reinvent most of these technologies are evolutionary, not revolutionary. So you really, the difference to get that 2 or 3% growth is really like mix and also innovation.
The high incrementals, you mentioned pricing is one of the levers, but pricing's essentially 100% incremental. I guess you have to take out that there's inflation in raw material costs about with the chocolate business, quite topical right now.
For sure, yeah. I mean, if you look at the history of cocoa prices, it's very, very stable until I got in the business.
Wow. All right. Well, we'll call that a coincidence.
Yeah.
Can you just kind of sum up the 4 characteristics that you saw that you said, hey, when I buy a business, these are the 4 things I want to make sure it has?
Yeah. So organic growth was one. What is operating leverage? The other one was free cash flow conversion. So what was interesting at the time in the market, people valued a lot of these names sort of on a relative PE and then premium or discount relative to what their expectation on organic growth was. But I didn't really get the sense then, but I think the market is smart enough to this over time that the free cash flow conversion of that income was very different across a lot of companies. And for especially multi-industrials that are really acquisitive, they had a lot of amortization. And so in a lot of cases, if you had a company like Roper, which was very acquisitive, but also it was extremely asset light, I mean, their free cash flow was actually 30% higher than their PE. So in terms of what was, that gave you a lot of extra capital to throw just at growth. If you have 100% free cash flow conversion of your EPS and you invest it at 10%, then that'll grow your earnings 10% a year, right? So, or if your PE is only 10, you bought back stock, same thing, right? You can either invest it at your earnings yield or you can invest it on future projects, which got to the last driver, which was basically growth in goodwill. Basically, the companies that were reinvesting and making acquisitions and were good at it actually were compounding faster, right? So if you're paying a dividend, you were reinvesting that, you weren't driving your earnings. If you're buying back your stock and you were at 20 times, you were growing your earnings at 5%. But if in the case of Ametek and IDEX and Roper and Danaher, they were investing in projects that had 15% growth. So here we got, if you're growing 4% organic growth, okay, you have operating leverage. You can drive that up to 12%. But if you also take all your capital and that capital, all your free cash flow from that year, and that's 130% of your PE, so you have a 1.3 times, let's say a 20% growth, that's another driver of 26% growth of your earnings. So like commenting all this, it was actually, you could really see what was the driver of long-term compounding for these names.
So what you're saying is essentially you wanted a good business that was growing with good incremental margins, good free cash flow conversion, but then the other leg, which is super important for long-term compounding, is do they have a process or a runway to reinvest that capital to continue to generate those returns on more capital? Or do they just take that money and give it back? And that's the profit of this. She said, I'm going to keep it because I'm going to invest it. And that's what these, companies, Roper, IDEX, Danaher, they became compounders because they had that reinvestment option. And I guess Buffett was like, I don't care if you have the reinvestment option or not. I do. Give me the money back. I'll invest it.
That's exactly right. Yeah. And really it's not necessarily just willingness to do an acquisition. It's like a process around it. I bought, in the case of Danaher, we bought this dental company and now we're going to buy all these little businesses for, that no one else can do much with. And we're going to get a 20% return buying those because we have a platform to put it on. And so it's earning the right to generate a higher return through all those other deals. You had other companies like when Ingersoll Rand acquired Train, right? This was this is back in the day, the companies all split back up again, but it was just like a big lumpy deal that it didn't, he was paying market rates for it. It didn't have the same, might as well bought his own stock, right? He didn't have any avenue for getting a better return on that than anybody else.
Well, the company shareholders might, but as a CEO of a bigger company, he might be in a different bucket and perhaps get a little bit higher comp. Maybe there was some golden parachute for the other CEO. Maybe there was dual change of control. It could have been a banker's dream.
That's a perfect transition to the oil and gas industry.
Yeah, they kind of took advantage of that corporate governance from time to time, I guess.
Yeah. Or just the growth of EBITDA with the oil service names. It's like, you always build more equipment to get more EBITDA. It doesn't necessarily mean that's going to be good for the stock or good for any of the investors.
Of all industries, to not look at EBITDA, you should be looking at EBIT, like high capital intensive businesses.
I know. It's interesting. And, when you're dealing with small business ownership, certainly starting, if you're a search fund or a personal invested trader, but all the debt is fully amortizing. And so, it's like, okay, within 5, 7, 10 years. And as I'm doing this and I'm like, for a candy company, I'm so stable. I don't need that. But I'm like, but the companies I used to cover in the oil service space, they definitely should have had that, right? Because the equipment was going to be dead in 4 years. So the bondholders, people giving them debt, really should have required them to pay them off while that equipment still existed. It's kind of amazing that did not exist.
Most traditional commercial loans would require that. It's just once you got big enough to get high yield corporate debt, that's when you didn't have the amortization. And that's a little bit of a different market. It's a privilege to be big enough to get that. Maybe move on to, you were a PM at Fidelity. What was that like? How did that transition work from being an analyst to a PM? How did you spend your time differently? You go there, then we can kind of transition to get into Hilliards and being the entrepreneur.
At the time, Fidelity had a $2.5 billion oil services fund, just investing in oil services, which is amazing because by the time I left Fidelity, I think oil services was less than 40 basis points of the S&P 500. So it kind of shows you this was back in 2010 or so. So that was my next role. And then after that, I became a energy specialist covering all of energy and running one of our energy funds. I was already running assets while being an analyst before, so I just had a wider group of stocks to look at. Trying to learn how to work with analysts is a good experience. Most of the cases, I think most of the analysts were better than I was as an analyst, so it was good. They always brought more to the table. I always, I think, felt like a PM, so I think I was always more kind of instinctual about a lot of things, while the analysts that were always working for me were obviously had their instincts as well, but also very, very thorough.
What skill sets did you use as a PM that you weren't using as an analyst? How is it a different job?
It's very much the same. I think an important part of the job is sort of stress management and volatility management, and just always trying to understand where you are and what you should be doing. And just always thinking those things through of, okay, like if I wasn't stressed right now, what would I tell myself to do right now when everything's selling off aggressively at this time? It's like, well, buy everything that I liked yesterday that's now cheaper. There's a lot of sort of that sort of mind thinking and philosophy of just trying to not be overwhelmed in the moment and just try to see it all the way through.
I'm also a big fan of using AlphaSense. They have a great expert library, and they also have AI technology that allows me to get to the information a lot quicker. They have a market intelligence platform that's trusted by 75% of the world's top hedge funds and 85% of the S&P 100. They use generative technology to surface key insights instantly from over 450 million premium resources, including company filings, broker research, news, and trade journals. And with the recent acquisition of Tigis, AlphaSense now offers the world's largest expert transcript library. It's 150,000 plus proprietary interviews, and that's growing by 6,000 interviews each month. Not only do you have the library, but they'll also go find experts for you. Let's switch to the chocolate business. So how'd you get into Hillards and the chocolate business, and how is that going?
I love stocks. I still invest very aggressively in my PA. But I think I kind of moved beyond wanting to invest against a benchmark professionally. It's kind of a slightly different role than investing absolute for yourself. And so I was ready to do something new. And I really liked the idea of buying businesses and, going back to my original industrial thing, finding ways to compound value and create value and make kind of good, low risk decisions that can compound over time. And while maintaining a career in finance doesn't fit that so much, right? It was like you're only in your seat for the next year or so. And so it, even at Fidelity, they try to see through cycles. They're very patient. It was the best place for me for sure to go into and build a career at. And I would recommend people certainly apply there and try to get jobs there. But even at that time, it just wasn't a good match for me at that time in terms of how I want to spend my time. And so I was looking at different businesses to buy. Initially, I thought about picking out a franchise that I believed in and they can have a good turnaround and buy a chunk of them and see if we can fix them. But the first one that I really loved was Hilliards. First one they came by, and it really reminded me of C's. And I remember I had a couple of opportunities to meet Warren Buffett. Once I was at business school, and again when I was at Fidelity, I remember him, sort of opining about how great the business is in terms of that it's, most retail businesses, manufacturing business aren't nearly as recurring as this one. And because it's a discretionary thing, most people don't think it is, but the reality is you only buy it a few times a year and you buy it for, people you care about as a gift. And it's not a big percentage of anyone's expenses. So you can raise prices consistently. And if you're selling people their traditions, if you're selling people their traditions with their spouse for Valentine's Day, they're not really going to care whether, that chocolate was $35 a pound or, eventually much higher than that if you raise price. So there's a lot that he pointed out for that. I was like, all right, that sounds pretty good. And then we talked to the owners, and the owners said, we asked you about pricing. They said they raise price every year. I'm like, check, that sounds good to me.
So I didn't realize you had met with Buffett during your schooling and during your career. Was that what really made you love this instantly? You just kind of took his advice. I didn't realize this was kind of a direct inspiration from the Oracle.
I actually got a ride in Buffett's car because so it was at USC and UCLA went
with
together.
Warren?
We went to go visit Warren. We had a 3-hour sort of meeting with him. And, we got to each ask different questions. And then at the end, he said, well, we're all going to, was it Gorat's or Gortats? It's like the steakhouse that he loves. And he was going to take us all to lunch. And so some people were going to be allowed to sit next to him who didn't get to ask questions, but I didn't get a chance to ask my question. So, we're like, all right, I guess it's my chance to go into the car with him. So we did. It was 5 of us, and we were in his Lincoln town car, had the license plate that said Thrifty on it. He was driving, and he was very into the conversation and less into his driving. It was a little scary, but we got there safely, and it was a memorable experience. I think it was at that first, when we were asking Q&A with the UCLA students, USC, that he talked about C's. I think we'd asked them because we're California, so we knew C's pretty well.
Let's talk more about how you got into Hillard, how you found it. This wasn't a buy, sell biz. This is kind of a step up. And then talking through that process of buying it, doing due diligence. It's a totally different experience. It's not just a price that you can just buy a piece of. You got to buy the whole thing. And you're talking about that diligence process and how it's different to buy an entire company versus a piece of a stock that you can kind of be out of in a day or 2 or 2 weeks. For me, when I was at the hedge fund world, in your seat, it might have been maybe a month or 2. I don't know how big you guys, I guess $2.5 billion fund, you might have been a month or 2 of liquidity.
We had the capital to buy. It was actually smaller than we were originally looking. But it was sort of, beginner's luck, I think, in terms of finding something and actually be able to close the deal the first time around. We decided to get banks involved to just establish a relationship. And we also wanted to set a precedent that we weren't going to take any personal guarantees on our deals going forward. So we thought it'd be good to say, hey, even though we're first time buyers, we don't know any experience in chocolate, but we're going to put very little debt on this. We're putting a lot of our own personal capital in it. Like this, don't worry about the debt that you're lending to us. And the bank had required us to do kind of a business plan for it. And so that was my responsibility to build it out. And it was really actually ended up being a great process to just do. And I remember part of what I was doing was, all right, let me just understand the chocolate industry and how everyone is situated. It's like, well, how many national names are there? It's like very few. There's like some internet, there's like Godiva, there's Lind, there's all these ones, but like, what's their presence? It's like, well, you have some retail stores here and there, and then they're also like in CVS and all these things. So it's like, okay, oh, this is a premium chocolate company I'm buying. So is that real competition? We're also in the suburbs. They're in the city. It doesn't seem like if you want high-end chocolate and you're in the suburbs, do you buy it online? And in most cases, no. I found an article where C said at the time that like less than 3% of their sales were online. And that was a well-known big company.
I buy my chocolate every holiday from Hilliards. You're on an email list. And for everyone who supports Pitch the PM, please, we'll send you the link for Hilliards, and please 10 people to buy Hilliards and get on the email list. It's delicious. My wife loves it for all the holidays, and now I'm getting it for the in-laws, my mother, everyone. So everyone loves chocolate.
We do corporates as well, so we can customize and send them out and do all the shipping. All you have to do is pick what you want, and then we can have like a sticker that says your company name and send it out to. We actually could do a chocolate mold of your business card too, and you can send it to people. So.
Well, business cards are dead, but chocolate business cards, I think that'll be around forever.
Exactly. Yeah. So like I was just trying to educate myself on the industry. And so finally I was like, all right, I'm just going to pick a city. I'm going to pick, Columbus, Ohio, and be like, okay, chocolate shop there. What do I learn? Like, what's there? And it's like, there's no national names. It's only some, there's maybe 2 or 3 small ones, and then one medium-sized company that's like 4 or 5 locations. Each one of these towns, it was, here's a chocolate shop. Almost all of them were in the 3rd generation. And it's like, how many businesses out there that are sort of retail, whether it's a salon or a dry cleaner or a restaurant, just continue to last to generation and generation. The reality is that people really care about their local chocolate shop. And by the time it comes to one generation being done, there's real value in the next generation getting in a way that doesn't exist for a lot of other retail businesses. Or somebody can see the value in buying that because there actually is a great cash flow stream, a great recurring cash flow stream that exists there that's worth somebody selling to another person buying. I just came back from the Retail Confectioners International in Cincinnati. And, it's all, a lot of people 3rd, 4th, 5th generation, or had bought a 2-generation business. But a lot of them, very few of them were open in the last 10, 15 years. A lot of them were a lot older. So it kind of told me a little bit about how sustainable the business is and how people typically buy and how they think about chocolate. It's a very emotional sort of connection that they have, and that there's a real benefit to that.
It's great. And so Hilliard's, how big is it? And how many stores? You've done another acquisition since then. So tell us, after you bought it, what did you kind of learn? What did you do with it?
Yeah, Hilliards was 3 stores, and we were lucky in that they had just built a brand new factory, and so we thought that was a good sign that we had now the ability to grow more stores afterwards. That we had this space and the equipment in order to do so. Right. Actually, it's not until this year, kind of 4 years into this, that we felt like we were at a position where we can actually build that 4th store. We're going to open one in West Newton, Massachusetts, hopefully this fall. But we're in the process of buying a building for that. When we bought the business, it was right in the middle of COVID. People were buying chocolate. I don't really know why. I guess they couldn't do other vices like gamble or something, or I don't know, but they bought a lot of chocolate. And so we had massive organic growth for like that first year and a half, which was a great thing to kind of buy into. And then the next 2 years, we're just basically digesting that growth. The company was, very centrally operated with the original owners who we had bought it from, and just didn't have like a layer of management to be able to execute on. Like, we were saying, like, all right, let's open another store. And they're like, we can barely get through these seasons as is. So it took a while for us to get ourselves organized, to then add somebody in HR, add somebody to be sort of a regional retail manager above the store managers to sort of support them and get good tenure in all these roles before we finally felt comfortable building a new location.
So you came in and then you put in a manager. So you guys are not owner operators, you're more owners and builders and let someone else operate.
Yeah. So the fourth generation, we didn't know what we were getting into with the fourth generation. We bought it from the third generation, and they said, our daughters are are in the business and they're great. And one of them, I think, would like to be sort of like a president and run the business. We're saying that sounds great, but we have to do our own sort of evaluation. And my vision at the time was that I was gonna probably just sit in that office and get this thing going at first and really figure things out. But as we started to get involved with it, we realized that they were very strong and really grew up in the business, knew the business well. So we were lucky that we had them. They continued to, we promoted one of them to president, another one to vice president, not one of the members of the family, but somebody who's been with the company for 20 years and very dedicated. And then we've since then hired some people below them, sort of support it. One of the other big investments we made was just in inventory, because we were transitioning this company from, we're going to make this much chocolate, we're going to sell it this much, we're going to have this much money, and we're going to distribute this, and this is going to support our families, to this is an ongoing business, and our goal is to make good investment returns, and we're not going to do we don't necessarily need that distribution at year end. We're hoping to reinvest it in some ways, or we'll take a distribution whenever it makes sense. But we're not managing for that annual cash flow payout. We're managing forever. So, it makes sense of we had this thing where we would buy some of the packaging, run out of a product, order more packaging. It wouldn't be on the shelf for 2 months while we waited for packaging, and then we put it in. And I was like, okay, what if we bought the whole year at once and had all that in hand? What would that do? It would lower our costs on the packaging by 20%, and our sales would go up by a blank amount to 15, 20%, because we would just have it year round, even if they were off season a little bit. But it was still good to, for example, chocolate covered Oreos, which very high margin and everyone loves. It was good to have those in packages year round. That's an example of, the IRR keeping that inventory of packaging was actually extremely high, and then we should do that, or at least purchase in a cadence that allows us to never run out of the packaging.
So if I now look at the See's Candy analysis from 1972, and we look at kind of the margins and how much he bought it for there, your company's obviously a lot smaller, but he paid, I think it was $25 million there, 15 million a book value or so, and 7, 8, 9% earnings yield. How would you compare and contrast kind of what he was able to buy in 1972 versus 2020?
I think when they bought it, they had a good path to years and years of strong pricing. With without that much, well, this is the 70s. There was obviously inflation at that time, but in terms of the materials and all that, when I look at the gross margins, usually gross margins for a candy company are higher than theirs. I don't know how much wholesale they were doing, because that would impact it.
When you say higher, I'm looking at their gross margins of about 53, 54%. You're saying they're normally...
They don't do any wholesale. I don't know if they're manufacturing chocolate for other people to sell. Assuming just the retail, if you're manufacturing just for your own retail, I would think most chocolate companies would be over, definitely over 65, as high as 75% gross margins. So I would bet that if they were, only online and retail, and that's what they were manufacturing towards, that I would suspect that they have margins closer to 70% now.
So if you're at 70, 75% gross margin, then the rest is your rent, your utilities, your people, this whole layer of management you put in, and then maybe even distribution, right? Or you're taking it from a hub and putting it to the different facilities. You need trucks and stuff. How do you benchmark that as a percent of revenue, or how do you think about those costs?
One of the things that we did was we basically figured out what the time it takes to make every single product. And then we created a system that if you made a plan, you said, okay, this is our scheduled hours for a day, and then this is our production plan for the next day. Do they match? Like, are you fully utilizing the employees that you're going to come in tomorrow for their entire 8-hour shift efficiently for that entire time? And I think what it taught us, I think that what they would do historically was, well, we'll make sure we'd definitely be able to manufacture this with this people, but they didn't know how much more they could do. And I think that more than anything else really helped the efficiencies when we did that math and said, no, you could do 300 more pounds of caramels. You could do this and that. And you can get that all done, this day. And then, and that would be understanding how to get to a full day. For a small business, really everything was Excel based. It was all went by feel. They always said, like, how do you decide what to make? You go in the cold room and look what you don't have a lot of. Like, we try to get a little bit more organized in how we do it, and that's really helped with the efficiency.
So did you implement like an ERP system?
So my business partner is building one from scratch, which is amazing, and it's worked wonders for Hilliards, and now we're putting it into Harbor Suites, our other company.
So you made a second acquisition, Harbor Suites.
Yeah.
How far into the ownership of Hilliards did you make that?
It was a year later. Right, a year and a half later, we acquired Harbor Suites, and we were now known as interested in these type of businesses. So first, we made a fund in Axial. This one came to us and said, "Well, you guys seem to have an interest in these. So would you like to bid on this company?"
Great. And so were you the highest bidder? Were you the chosen person because you're local and you're the chocolatiers, the up and comers?
So I think we were definitely, a preferred buyer at that point. I don't know how many other offers they had. The broker implied they had many, but I know.
Yep. Always do, right? I mean,
yeah.
Brokers in this business are interested. It's like a license to lie. That's what I put. It's like the company didn't say it. So when you signed, everything we've said is that what they said is all true and accurate, but what the broker said and the forecast, and I'm like, oh man.
Yeah, the forecasts aren't in. Well, especially after knowing a chocolate company and knowing the financials, seeing what they've put out there, and just if this doesn't even make any sense in terms of the leverage in this business.
So when you looked at due diligence, was it just tax returns? Is that how you kind of verified things?
Yeah, well, we got a quality of earnings from our Gray & Gray is our accounting firm. They did equality of earnings on both companies, and everyone we talked to, we had some mentors who had bought businesses who helped us, and they said, don't skip that step. It's an expense in the transaction, but I think it's necessary, certainly for first time buyers, to really have somebody go through and look through. I mean, for both companies, the financials were very, very messy and had a lot of weird stuff in there because it amazes me that all these small businesses function. Considering how difficult it really is to do the bookkeeping and have it be accurate. There are definitely times where you don't even know what your revenues are at time because you just have different data sets. It is more complicated than you realize.
How long did it take you from the time you saw the ad on Axial to closing the deal?
Probably about 8 months for Hilliards.
And what about the other deal? How long did that take?
That one had some kind of fits and starts and all that, but that was probably about the same.
Wow. Okay.
Yeah.
A lot of due diligence. This isn't being pitched a stock and buying it in 2 weeks when the IPO comes out.
Yeah. I mean, but also just the process of all the legal and all that. That's you have to do the quality of earnings, but also, there's a lot that goes into the transaction. The other thing is these are both asset purchases. I don't know if you've ever on these calls gone into asset purchases versus corporate purchases or stock purchase, but asset purchase has a lot of, it's the better way to go as a buyer, just in terms
of liabilities,
from the liabilities and everything. But it's so complicated, especially when you have like point of sale system needs to switch over. All this stuff needs to switch over in a day. All the leases need to be switched over. It's a mess.
It's an extra step when you do the asset that you have to switch the names because you didn't buy the company. Where are you trying to take this business? You said it's a regional business. What are you doing now? Where's this business likely in 5 years? What are you trying to do with it?
Yeah, I mean, going back to C's, right? If you look at it like, okay, he bought it at 8% earnings yield or something. It's like, okay, is that what he's in the free cash flow conversion? I assume was probably about that, right? Say, all right, like, so what does he hope to get, right? First is he would hope to get organic growth, right? Going back to the four things I was looking for with industrials, organic growth. Well, these are pretty established businesses, but as a business owner and it's a local retail thing, you can bring out new products, do better advertising, like try to drive your organic growth. Operating leverage is high in this business because your gross margins are high. So if you can sell more chocolate, the better. But really, what intrigues us is sort of the incremental return on invested capital and what you can do next. So the one part that probably is not obvious when you're looking at C's is a brand. Everyone knows the brand. Everyone likes the brand in this general area. They can open new stores and those stores can do better. Certainly, like if you started Garber's chocolate, you wouldn't have any manufacturing. You wouldn't have a brand. If you opened the store, nobody would know what it was until they went in. But if you open a C's Candy somewhere in California, they're like, we got a C's. Buffett, when he bought C's, bought the right to open 100 more stores, which I believe they did over the next 40, 50 years. I think that's one of the things that was kind of missed when looking at how C's was able to compound, is that he also bought the ability to, let's say, spend $300,000 to open a new store and have it generate $200,000 of free cash flow. Let's say he bought it for 10 times earnings. So if you spend $300,000, but you generate $200,000 of earnings from it, you converted a $300,000 investment into a $2 million asset. And so that's he was able to do over, with 100 new stores or something that he built over that time. That's our hope with these companies, is that the incremental, we understand we already have a brand. We have, the new store we're opening in Newton. Hilliards used to be there in the 30s, 40s, and 50s. They used to own more stores, with smaller stores, but there are people in that area who know it. We're coming to there with a 100-year-old brand that's local in Massachusetts with our own brand, with our own logo that we've had, and we have 1,000 different chocolates that we make that we can fill up a store right away. And the hope is that we can the IRRs and the paybacks on new stores would be very high, and that's what we're hoping to prove. But with both companies, we also have a kiosk that we're building for Harbor Suites in downtown that I think is going to get a lot of attention and do quite well.
Why have two brands? Why not merge them into one brand? Is there different concepts, different areas?
Well, the brand is what you bought, right? Like we thought about that because there's also like one-off small ones that it's like, oh, like we could, people have been buying from this candy shop in this town, for a while, and it's a little run down and tired. We can come in, but it's like what makes our business so stable is what would anger people if you got rid of it. And also, like you're manufacturing in their hometown, you're employing people in their hometown. This idea of just sort of like, oh, this isn't what it has been for the last 100 years. It doesn't make any sense. It's the brand that you're purchasing. We do think that they have different strengths. So Harbor Suites is more catalog, more online. There's a higher price point, but kind of more narrow. They haven't had to fill up like a 2,500 square foot candy store before, so they don't have as many products. So our plan right now is to go the kiosk route into the city with Harbor Suites, and also hopefully, across the coast, and that Hilliards will be the, kind of the go-to candy store, be more of like the C's that you see in every town in Massachusetts.
How much of your sales are online at this point?
For Hilliards, it's quite small, probably similar to what C's was. And then for Harbor Suites, starting with catalog, that had a transition. So for them, it's more like 40, 50%.
And is the margin comparable when you go direct to consumer with the shipping cost versus the retail presence?
Yeah, it's more or less the same. Yeah.
It's been fun. It's been fun to keep up and to hear now all the fun you're having up in Boston. Thank you for taking the time out of your day. And I look forward to let's stay in touch.
For sure. Yeah. Good luck with this Pitch to PM. It's I'm a listener, and it's good content.
Great. I appreciate it. Thanks.
Please make sure to follow Pitch to PM on your favorite podcast app and never miss out on episodes. This show is for entertainment purposes only. Please consult a professional before making any decisions. This show is copyrighted by Pitch to PM. Written permission must be granted before rebroadcasting.